Welcome to Central Bank Central. I'm Kathleen Hayes. Today, at long last, a jobs report, payrolls, unemployment from the Bureau of Labor Statistics, from the government. Well, remember everybody, of course, we had the shutdown for a while, didn't we? And that prevented that department from issuing these very important numbers, important not only to the Federal Reserve, but certainly to businesses, other institutions that are trying to figure out where the economy is, where the economy is going. This is one of the most important reports they get. And another part of today's report is that it came in stronger than expected. So I am very happy to welcome back to Central Bank Central Kathy Bostanjcic. She is the chief economist for Nationwide Mutual, joining us from her roost, analyzing the data. So, Kathy, I want to start with this question. It has been what, about 2.5 months since the Fed got the jobs report. We know that this again is something that's been a big question mark. If they just had to do another rate cut or felt inclined, barely though, very contentious inside the Fed, it looks like. And how important is this report? Even though I want to make it very clear, this is the September jobs report, right? So it's not the latest, but how important is it to the Fed now? If do they consider it old data, or they say, like I just did, finally some up-to-date sort of data that tells us where the labor market might be?
Well, thanks, Kathleen. Happy to be back with you. No, you're right. In a sense, it's old, stale data from September. On the other hand, it is the gold standard for employment updates on the economy. And so while we had some private sector data to kind of chew on in the meantime, this is really great to get this type of data. I think, from my viewpoint, what it does is just further throws cold water on the idea that we are going to get a December rate cut from the Fed. Those odds were already declining even before this morning's number. One, because, as you indicated, the Federal Open Market Committee is increasingly more divided between, the so-called hawks and the doves. The hawks who say, "Hey, I'm a little worried about inflation being sticky," and the doves who say, "No, I'm more worried about the labor market." In this data void that you talked about, the hawks' voices have kind of risen louder, and I would say more, officials sort of joining that part of the divide. So I think it was going to be a tough hurdle no matter what we got this morning. But the fact that it actually was stronger than expected, I think just supports the Hawks case. The only
Oh,
little wrinkle there, not wrinkle, but additional data that kind of we have to digest is that the average hourly earnings increase was only up 2/10 on the month. We had been used to seeing 3/10 per month, right?
okay.
That actually, ironically, the bond market started to price in a little bit higher odds of a December rate cut, saying,
Okay.
hey, don't have wage pressure. That should help the inflation picture. But I think overall, the Fed is, and because we're not going to get October CPI, we're not going to get the household survey for October, the employment data. We will get the establishment non-farm employment count, but that's going to be folded into the
Okay.
November report, which that itself is going to be delayed until December 16th, and the Fed meets on December 10th. So
There you go. So there, but still, it is important, and that seems to make so much sense to me. It's as you said, it's the gold standard for the data. So for people who aren't just glued to their screens or every single second like we are when it comes to this kind of thing, let's go through the numbers and what they are, what they were, and how they sort of measure up to what you just said. Because we can start with 119,000 jobs reported, payrolls, that is, in for the month of September. And actually nearly 100,000, 97,000 were private jobs, right? So that shows us a sign that businesses are hiring. And that was after that 4,000 drop in payrolls in August. Eye opener, no wonder the Fed in that September meeting was saying, whoa, maybe we better do something. But also the private jobs were up as well. Some revisions in the 2 months before that. But how surprised were you seeing that number? I remember when I was out in Jackson Hole when the data had pulled back all of a sudden July and August so much, a lot of people were making the point, hey, look, it's a different kind of labor market. There's been deportations. People aren't pouring across the border like they were. And the natural rate of employment growth has dropped maybe to 50 or 60,000. Some people would have said less. And all of a sudden you get 119,000 jobs.
That's right. The break even, so-called break even on non-farm payrolls is probably around 50 to 60,000. So the fact that, and break even means it just keeps the unemployment rate steady. The fact that we got more than double that, right, or roughly double that, suggests that September was very strong. Now, of course, you do have to balance that with August, or maybe even the month before, and look at a 3-month moving average, and it's more moderate. But I would still say it's a more improved picture than what we thought. And it tells us like right before the government shutdown, labor market was not on the precipice of declining sharply. That there was some strength and a rebound. Now, what we really do need to see though is that the October and November data really to see what the momentum is. But we did get a more up-to-date reading with jobless claims, right? Those are now being released on a national level. And it was very low. 220,000 was initial jobless claims. So there's not a lot of, despite some headline announcements, there's not a lot of layoffs going on in the economy right now. So I think the labor market, it's solid. I wouldn't say it's booming, even though September's a little stronger. It's solid when you average it out over several months. And then if you look at some of the details, you broke down some of that. If you go within private sector, really was concentrated again in healthcare, social assistance, leisure,
Mhm.
hospitalities.
Yeah.
Not that, but those jobs matter, right? It's just
Yes.
that it's not broad-based. It's pretty concentrated. Not new though. We've seen that for about 2 years now. Really focused on kind of that secular healthcare portion. But
Hmm.
that's enough to keep the consumer overall buoyant. And that supports GDP growth, of course.
So in terms of the unemployment rate, because again, that's what a big headline for a lot of people, particularly people who are not looking at the whole report. Oh, look, unemployment. Oh, it's up to 4.4% in September. It was actually up a tenth from 4.3. And it had fallen to, I guess, 4.1% in July. Uh, and then, rose again. How do we interpret that? I mean, in a sense, the unemployment rate comes from a smaller survey, but it's been around for a long time, so we watch the trend. Does that kind of show something people the Fed would be concerned about, or is it more in that vein of, well, it's kind of in a range? And then you look at the weekly jobless claims, which just were released, and as you said, a very low kind of standard number for an economy that's growing. What do you, how do you put the unemployment rate in this discussion and debate? How do you think the Fed does?
Yeah, no, it's a great question. So I think, prior to the September data, the unemployment rate was rising gradually. It's still very low, right? Even it was 4.3 before today. Um, when you kind of try to assess, okay, how much has a decline in supply of labor versus demand played out in the labor market, right? So are we getting, we said the break even number is lower on non-farm payrolls, and that's because labor supply has declined a lot, right? We have stricter immigration enforcement rules now. But, you know, at the same time, the unemployment rate rising it was indicative of demand cooling more than supply. So meaning there really was a slowdown in labor market. That's what Chairman Powell flagged. Other Fed governors, Governor Waller particularly, was very adamant making the case the labor market's softening. We have rates too high. Let's cut them. Today's increase, though, wasn't as worrisome. It's because more people entered the labor force. So the so-called participation rate rose slightly. And if you look at the household survey, which also produces employment estimates for the month, it was even stronger than the non-farm payroll increase. It was up 251,000. So it really shows across the board, at least for September, we had a very, very strong month for employment.
Well, I'm glad you made that point about people entering the labor force, pushing up. the unemployment rate because suddenly someone who was thinking, oh, I'm not going to look for a job. It's not there for me. They go, oh, maybe I've got a chance. Now I'm going to look again. And they usually do that when they see signs around them or broadly in the economy, when if they read the news that things are picking up. So it once again, it seems like it, maybe you're just coming out of a little bit of a hole, but at the very least, this is a sign that there is activity out there. Now, maybe it's more in health. I mean, for example, manufacturing jobs, manufacturing overtime, especially weak in this latest report, right? So it underscores your point. But enough people, I guess you could say, are in certain industries are hopeful that times are at least as good as they were, if not getting a little bit better, time to look for a job.
That's right. Absolutely correct. And because otherwise you have that so-called discouraged worker effect where, yeah, I'm not even going to bother to look. That's the worst outcome, right? So it is slightly more encouraging. But you mentioned manufacturing and some other sectors that, we watch that are more considered more cyclical. They've been weak for a long time. So
Yeah.
it really, in our view, it does make the case that the Fed Reserve could start to lower interest rates. Even though the secular growth of employment is steady in healthcare, particularly, you're seeing the cyclical sectors of the economy still kind of suffering, really. We don't see the inflation increase we've seen as persistent or picking up, and we don't think further rate cuts are going to fuel that. We think that there are other factors going on. Productivity growth has been quite good, and with the advent of AI, once that really kicks into productivity growth, is actually disinflationary. We may not be there yet. That's probably it's a little premature to declare victory there, and that's why some of the Fed officials, and then we had announcements from Walmart and other retailers. Even though Walmart beat expectations and guided their outlook higher, they said they were warning that price increases may be coming. So maybe that is that still delayed tariff impact feeding through the goods, and maybe they plan to pass it on to consumers. So that does give, especially the Fed presidents, the regional Fed presidents, a little pause and supports their case. Hey, what's the hurry? Let's wait and see more data before we start to cut rates further.
Well, I guess maybe the reason some of these big retailers feel like, oh, I can start pushing through some of these prices that I've been just, factoring in and, cutting away from the bottom line, um, that that they can see what we're talking about, what you're talking about today. Hey, this economy's holding up. This economy isn't falling back. And so that it is a good time for them to maybe start doing this. And maybe this is the kind of thing people have been more concerned about, that maybe inflation won't fall and maybe becomes a little more persistent if these are gradually going to leak into the economy over time.
Yeah, absolutely. That is the concern of some of the Fed presidents. Even they're not current voting members, but they'll be rolling on next year. Like I'm thinking about Beth Hammack, who's the president of the Cleveland Fed Reserve, and also others, regional Fed presidents that are a little bit more concerned. Lori Logan from the Dallas Fed about that very phenomena you talked about, and that may be very well the case. The retailers are going to wait and have waited, and given some of this resilience of the consumer and the economy, figure, okay, with the new year, particularly, we could start to roll out and push through some of these higher prices.
Right. So you mentioned AI. So, and I think I'm sort of totally in your camp when you say, oh, everyone's talking about the productivity increase, and it's going to take a while. Just because there's big investment in it, and a lot of big names, billionaires are just putting more and more in, and it is. But I guess partly it does before you get a lot of the productivity, you get jobs, don't you? I mean, all the in some places for all these plants have to be built, and so what is overall, if I said, what do you think AI is going to do to the economy? Where are we now? How does Kathy Bostanjcic answer that question?
Well, great question. So our team has done some work, and we've estimated the direct build of these data centers and the investment in software has contributed about 1.2 percentage points to GDP growth in the first half of the year. If you
Wow.
look at the growth in the first half of the year, it was only at 1.6. So three-quarters of the growth directly tied to the data centers. Then you could add in the indirect impact, which has been stock market is soaring, particularly the tech stocks. That feeds into the wealth effect, which allows upper income households to spend more, right? Like top 50% of households own stocks. And if their portfolios look better, they're looking and saying, "Well, I feel wealthier. I can spend a little bit more." And so we see that going on. So it wouldn't be, a stretch to say that maybe 80% of the growth, at least 80% in the first half of the year, was coming from AI, either directly or indirectly. Now, that does raise some questions. On one hand, thank goodness, because it did help with growth, right? And it could really fuel, in the camp that it's going to fuel productivity gains going forward. Um, but I also worry that there's such a high concentration. I'd like to see a broader economy, a broader based economic growth, and also less, and that just feeds into and supports that whole K-shaped narrative that we've all been talking about, that the haves are doing better, both households and businesses, and the have-nots are falling behind and really struggling right now.
So let's talk step back to even the a bigger picture here that everybody's watching in the Federal Reserve universe and beyond, I should say. Fed dynamics and environment where we're heading toward the January meeting. FOMC is going to then choose a chairman, of course, we assume that the president will have announced his choice to replace Jay Powell, the current Fed chair, by then. We got, in fact, a lot going on. Stephen Miran, the new board governor who's descended twice now for bigger 50 basis point cuts. He thinks the Fed's really got to go hard and fast on rate cuts. And so does this, first of all, does this concern you? Do you think this is an issue for the current trajectory of policy and this whole question of Fed independence and where it's going or not going?
Yeah, I know. I think it definitely is a concern. The Federal Reserve doesn't want to lose its independence. That would really be quite a negative for the economy and the financial markets. Investors don't want that. They really want the Fed and the next chairperson to decide monetary policy based on data, not political influence or pressure. So, um, you know, it may be that Fed Governor Myron's right. Maybe interest rates are too high and they should go more aggressive, but it should really be based on the data, not this perception that it's coming from a bias. That said, I think he does really believe it too. So it's a difficult question, but I think that really it is very important for the Fed to be seen as kind of immune as from political pressure. It just complicates everything. And it could be the Federal Reserve. You could make a case the Federal Reserve cuts, short-term interest rates, but long-term rates go higher because they're worried that inflation expectations are going to rise, that they've overdone it. Um, we'll have to see, really assess the composition of the Federal Open Market Committee, because also the chairman alone, while very powerful and sort of directs things, right, isn't the only voice. There are 19 members of the Federal Open Market Committee, and only 12 of them are voting. But it is a wider range of voices there. But we have to see, because there's, the Fed governors reaffirm the appointment of Fed presidents. So all of the regional Fed presidents are up for reappointment in February. So that also becomes tricky. Like, is there potential that there's even more influence injected from the president into the broader committee? We will have to see. And who's chosen, right? I think I all the candidates, to be honest, have some real, I think, good credibility. Some are seen as less political than others, right? If I'm just as an extreme, if I think of Kevin Hassert, who's very much embedded in the administration, I think of Fed Governor Waller. Yes, he was appointed by President Trump, is in favor of lower rates, but is really a Fed institutionalist. And so I think, the markets would be much more comfortable with someone like him. versus someone who's seen, a little more political.
Speaking of being political, this is a kind of a random question, but someone suggested to me, oh, you look back at the delay in the BLS report, maybe that was some political, not at the Fed, but around the Fed, some thinking, some push to hold it back so the Fed wouldn't see the latest jobs number and be more willing to do the rate cuts they've done. Do you think, is there anything about this that you've heard or seen that gives you gives you pause to think, well, maybe so. It's hard to say though, isn't it?
So my sense is they're really delaying it because it's not just, hey, we turn the lights off, let's turn it back on, everything goes back to normal with data collection and assembling the data and publishing it. Also, these agencies are down about 25% of personnel over the last year, and I think since the government shut down, they've probably lost even more people. And I think that upper ranks, it's something like a vacancy of a third. So this is really serious. There's a lack of researchers and the statisticians who work on this data and collect it. And I think that makes it even slower to be able to then get back onto track and assemble the data. Now, if the idea was let's delay the data until after the meeting, it's backfired because what's happened is the hawks have gained the upper hand, saying, hey, we don't have enough data to make this decision. We need to wait. As opposed to the doves who want to cut rates, saying, oh, you know what? No big changes, nothing, no data to dissuade us from that. We'll just go ahead and cut rates. It's actually the opposite has happened. So.
So let's come back to you and the Fed and what you see because I think I'm interpreting you correctly from the start of the conversation that having seen these data, first of all, you think the Fed is there's just really cuts back the chance, which was market had already mostly cut back on a December cut. In terms of what you think the Fed should do, and as you look into 2026, are you more in the camp that says, no, we can really afford, we really should be thinking about cutting rates again when we have more data, et cetera, even with inflation still so far above target, right? Close to 3%, 4.5 years in a row. Does the Fed lose credibility? Which side of that, or just not even a side, what do you think should happen and will happen?
Yeah, it is a tough time to make, policy decisions. But I'm in the camp that they should be easing rates. I do think that the level of rates is too restrictive, um, given what I see in the cyclical economy when I look at the lower K, right? So the upper K, I don't think, stock prices, AI investment, households, connected to that. I don't think interest rates are factoring too much into their decisions, right? They're probably locked into low mortgage rates. They're not really levered up on their credit cards as much as the lower portion of the K. They're maybe not, they maybe don't even need to rely as much on auto loans, right, to purchase an auto. But middle income, lower income households are feeling the pressure. And so I think lower interest rates could really help them. Now, the caveat is I have to be right that inflation is kind of reaching its top and is about to decelerate next year. Um, if that's wrong, then those lower income households are still going to struggle because really probably the end of the day, the inflation flare up, and it's not now, it's really what's been happening since post COVID. That's really hurt them a lot. Initially, when we were backfilling jobs, their wage gains were above inflation, but then it has changed and they've fallen behind. So I think that it is a tricky question. I got complete respect for those who say let's slow things down and wait. But my sense is I'd like to see a lower interest rates to help the labor market picture, but also to lower rates, borrowing costs for those households who are not, part of the AI boom, frankly.
All right. Well, Kathy Bostanjcic, thank you so much. We've covered a lot of ground today, as always.
Yes, it's been great. Always great to talk to you, Kathleen.
Thank you so much. Kathy Bostanjis is Chief Economist at Nationwide Mutual. I'm Kathleen Hayes, and this is Central Bank Central.